Florida Community Association Management is a high-stakes operational environment where errors carry immediate financial and legal consequences. Success as a licensed community association manager requires the active synthesis of law, accounting timelines, and procedural rules. To operate legally, these three distinct areas of the LCAM curriculum must be applied to association business simultaneously. Association operations are governed by a sequence of strict deadlines, the statutory shot clocks, where a single missed day can trigger a legal violation. Effective management relies on mapping these specific legal codes against a unified, interconnected operational calendar. This diagram outlines the temporal framework governing all association operations. It scales from 0 to 120 days. At the 48-hour mark, the association must post an open board meeting notice and detailed agenda in a conspicuous place on the community property. At 10 business days, the risk of statutory penalties begins. This is the window an association has to provide access to official records after a written request, or to deliver an executed estoppel certificate. At 14 days, the timeline establishes the minimum notice requirements for mailing proposed budgets to owners and for notifying residents of official compliance committee fining hearings. 30 days is the minimum time an owner has to pay a ratified fine or cure an infraction. It is also the window a board has to distribute a milestone structural inspection summary to all unit owners. At 45 days, the collection and enforcement warning clocks engage. Both condominiums and HOAs must provide a 45-day written warning before filing a claim of lien, and another 45-day warning before initiating a foreclosure lawsuit. At 90 days, we hit administrative limits. General and limited proxies automatically expire. Additionally, a developer has exactly 90 days post-turnover to deliver all corporate books and records to the homeowner-controlled board. The matrix ends at 120 days. This is the absolute legal deadline from the close of the fiscal year to deliver the completed year-end financial statement packet to the membership. Tracking these moving clocks is the primary challenge for a manager navigating sudden, multi-layered legal conflicts. Consider an operational scenario involving a paid manager overseeing a community of 420 residential units with a $450,000 annual operating budget. The community's master declaration contains a local rule: no commercial vehicles or assigned work trucks may be parked anywhere within the boundary lines of the property. 2 complaints land on the manager's desk. Neighbor B is parking an assigned Comcast service van in their personal driveway. Across the street, neighbor C mounts a 30-inch satellite dish onto their attached townhome roof. Because this community exceeds 10 units and clears the $100,000 budget threshold, the paid manager is legally required to hold an active Florida LCAM license. The manager reacts by issuing a $100 fine to the owner of the work van and ordering a crew to disassemble the satellite dish. This jurisdictional hierarchy pyramid dictates that local covenants and association rules sit at the bottom of legal authority. Under Florida State Statute 720.307(3), an association cannot prohibit an owner from parking an assigned work vehicle in their own personal driveway. The state statute explicitly overrides the HOA covenant, rendering the manager's fine illegal. The satellite dish removal falls under the Federal OTARD rule. This federal guideline protects the right to install a dish under 1 meter on property within an owner's exclusive use or control. Because a townhome owner typically owns their roof fee cycle, the manager violated federal law by destroying the dish. Enforcing governing documents without running them through the filter of state and federal preemption can transform a manager into a primary source of legal liability. There is a secondary administrative flaw in the manager's process. To mail the illegal fine, the manager paid for the certified postage using an association-issued debit card. Florida law strictly prohibits the use of debit cards tied to association accounts to prevent untraceable fraud. All association outflows must move through heavily tracked approval pipelines, limited to checks or ACH transfers. In this scenario, the failure to understand statutory preemption and financial firewalls resulted in federal violations, unenforceable fines, and immediate exposure to the DBPR. In a condominium setting, an 80-unit mid-rise generates $310,000 in annual revenue, operating on a December 31st fiscal year end. On March 15th, the board realizes their operating account is short $15,000, risking a service shutdown by their elevator maintenance vendor. The board president executes a transfer, moving $15,000 out of the roof replacement reserve account and directly into the general operating account. This transfer hits a rigid fiduciary firewall under Florida Statute 718.112 regarding statutory reserves. Restricted statutory reserve funds cannot be reallocated to pay for operating expenses by board fiat. Reallocating those reserve funds for an alternate use requires a prior formal majority vote of the membership. Without that vote, the transfer is a fiduciary breach. The board then attempts to save money by hiring a resident to perform a basic financial compilation, instead of retaining an independent CPA firm. This ignores Florida's statutory threshold updates. Since the association generated $310,000 in annual revenue, they must meet a higher reporting tier. Any association generating $250,000 or more is legally required to obtain a full independent audit performed by a licensed CPA. Applying the master matrix to their delivery timeline, the 120-day absolute limit for year-end financial distribution falls on April 30th. The fiscal year ended on December 31st. The association had exactly 90 days to prepare the audit and 21 days to distribute it, totaling a maximum of 120 days. The board posted their compilation to the member portal on May 15th. By posting on May 15th, they missed the statutory shot clock by 15 days, exposing the association to state fines. These scenarios illustrate the ultimate lesson of the LCAM matrix. Management requires navigating a multi-layered environment where a single action can trigger an accounting failure, a reserve violation, and a blown statutory deadline at once.